Every day I get asked the question, what stock should I buy and what are the best sectors to invest in? Hello and welcome to this week's Australian Stock Market Report. I'm Dale Gillham, Chief Analyst at Wealth Within. This week I'll be taking a look at the sectors in the market that are set to rise and where you can find the best stocks for your portfolio. I'll also give you my views on the All Ords Index and then get into the stocks of interest for this week. First, hit that subscribe button and click the bell on the right of it so you keep up to date with our latest videos. Also remember to tune in to our live Australian stock market show every Tuesday, 7 to 8 p.m. Australian Eastern Time. Every day I get questioned by investors, traders and the media about what sectors and stocks to invest in and which ones to avoid. Let's face it, what they really want me to do is share with them where the next big opportunities are coming from, so that they can get in early. But it's not quite as simple as that. To understand where the opportunities are coming from, you firstly need to look at the past and how each sector has been unfolding to date. You then need to look into the future and study the metrics that might affect each sector moving forward. Metrics such as interest rates, currency movements, PE and EPS ratios for the short, medium and long term, dividends and the list goes on. All this can be quite challenging for those new to the market, and so I understand someone wanting me to set them on the right path. In a minute I will share with you 2 easy ways as to how you can determine for yourself the best sectors to invest in, and I'll give you the sectors I like moving forward. Finding the right sectors is one thing. After you determine that, you then need to find the stocks that suit your portfolio and the analysis starts over again. So how do you make all this easier for yourself? Well, quite simply by learning how to read the charts of the sectors rather than look at all the fundamental metrics. Now before we look at that, we need to discuss sector investing. In its simplest form, investors just want to own stocks that are rising in value and buy other stocks that will rise. But here is where things start to fall apart, as they start talking about diversification into sectors. For example, investors often believe that stocks in their portfolio should closely represent the sectors so that they have a balanced portfolio. Yet this is not wise if you wish to get good returns. Let's face it, stocks rise and fall, and sectors rise and fall as a result. So in the interest of getting good returns, it makes sense to avoid sectors that are falling in value and only invest in ones that are rising. The table on your screen right now shows the sectors in the Australian market, and they're pretty much the same sectors you will find in any stock market around the world. Stock markets use a standard classification system for stocks called GICS, or Global Industry Classification System. Having this classification system means investors, both professionals and private, can easily understand what industry sector a stock is in. In the table you can see the 2018 growth for each sector along with the year-to-date figure in 2019. Now in 2018 you can see that the biggest loser was the Telecom Sector, and that was down 25.3%. And the biggest winner was healthcare, rising 17.33%. As money continually moves into and out of sectors, in general we can assume that the best performing sector in one year is unlikely to be the best performer the next. This is the same for the worst performer each year. Now looking back at the table again, you'll see that the telecom sector has reversed its fortunes from 2018 and risen 20.23% in 2019, whilst healthcare has only increased 6.62%. Now if we look at the next best and worst sectors, you'll see a similar pattern as consumer discretionary was up around 9% in 2018, only to fall slightly into the negative so far in 2019. Now financials was down 14.78% in 2018, only to turn and rise in 2019 to now be up 3.68%. Whilst this is just a small snapshot in time and it shows a definite pattern, this example is a little oversimplified. Sectors and stocks rise and fall at constantly changing speeds. and sometimes they rise or fall over multiple years. And so whilst this theory is a good guide, it's not a hard and fast rule and should never be treated as a hard and fast rule. That said, the pattern this example reveals is that by having a contrarian view, you are more likely to select the next best sector. The exciting part is that once you identify the sector, you can also bring this exact same theory into stocks to find the ones that are likely to rise in the near future. Now let us look at a chart to determine the most likely best performing sectors moving forward. On your screen right now is what I like to call a spaghetti chart with all the same sectors listed as before. Now the lines are color coded so you can easily recognize each sector. For example, the text XIJ is marked at the top of the chart in an olive brown colour, and this relates to the line of the same colour immediately on the left of the text. So how do we read this chart? Quite simply, we're just looking for the sectors where the line is moving up and down. The XIJ, XMJ and XHJ are all moving up at different speeds, which is indicated by the steepness of the lines. The XUJ, XDJ, XFJ are all currently moving down, suggesting they are falling. And again, the angle reflects the speed of the fall. Now the trick is to watch the sectors that are falling and wait for their line to show signs that it is turning to rise, and then this sector you could look to invest in for the future. For example, you will see the XEJ has recently turned up in price. And so I would look at the energy sector for stocks that have also just started to rise. Now the other way you can look at this is the steepness of the line. If a line is only rising slowly and then starts to increase its speed, you know the stocks in that sector are starting to move faster and so may represent a good opportunity to buy. So what sectors do I see that will perform well for the remainder of 2019? Well, from the table and chart we've just discussed, I like energy, financials, telecom, as they will most likely turn around to rise, and I also think materials and information technology have a little further to go. I also think that healthcare, consumer discretionary and consumer staples will remain slow for a while longer. So there you have it. I've shown you two really simple ways to assess the sectors for yourself, one on a spreadsheet and one on line charts. Now have a go at looking at the stocks in these sectors that we chose to see if you can find some that will outperform in the second half of 2019. Let's go and take a look at the market and then some of the stocks of interest for this week.
Please remember that this report is an educational tool, and as such, your personal circumstances have not been considered in the analysis of the compilation of shares included. The content of this report cannot be considered personal financial advice. If you have not done so before, pause the video and read the disclaimer on screen. We hope that you enjoy this week's report.
Well, they say a week can be a long time in the stock market, and last week it was one of those weeks, wasn't it? I mean, if we're looking at my market report the week before, or my recording from the week before, I was talking about this sort of green area, how all the opens and closes were around the same point. Now, and I said, if the market did come back during the week, or this current week, with the week ending, as you can see, the week ending the 12th of April, if it did come back down and do exactly what it did before, then it was more than likely it was going to come down to sort of this 6136 or possibly down to 6,000 points. But if it closed higher, then we'd likely go up towards challenging that all-time high. Now, it's quite interesting, our market, if you look at this quite simply, it opened at 2720. It's also opened on its low. Its high was 3437, and that's exactly the high for the week. So very much opened on its low. It closed on its high. And if you look back onto the left, you see that's very rare that it does opens and closes on its high and its low, which means it is reasonably bullish, the market is. So if you watch on my last Tuesday night's live session with Janine, when we do our live YouTube stock market, Australian stock market, you'll have a look at, I talked a bit about how the market or had two ways that it might unfold. And so I actually drew that on the chart and I said, well, this is one way and this is another way. So obviously this is looking like it's going to be really, really bullish now. So I would expect this to continue on, but stranger things have happened in the market where it just reverses the next week. So at this point in time, though, I think we're going to be enjoying 2 to 4, maybe 5 or 6 weeks more up on our marketplace before we have another pullback. But it is, as I said, it is quite interesting times on our marketplace, especially with the election. And I know I have a few people talking to me about the election because that was got announced just the other day, and saying, oh, look, hold off, because if at this point in time, Labor is looking like getting in, and if they get in, the market will pull back. And it really is, how do I say this? Looking at election and determining what the market's going to do is not necessarily a wise way to look at the stock market. You see, the stock market is a leading indicator, not a lagging one. And it's going to tell you already, the big end of town are making decisions because they've known that the high probability that Labor is likely to be in power. They've known about it just the same as you and I. They've known about it for months and months and months, just with all the polls. So, and whilst that's not carved in stone that the Labor Party will win, it's high probability at this point in time. And so, therefore, what I like to talk about with the governments is it's like the government is the captain on the Queen Mary or a huge ocean liner, and you just can't stop momentum. If they're motoring along at full speed, trying to stop them can take miles and turn them around, etc. So to me, the government's exactly the same as that. Doesn't matter if you change captains, the boat is still moving on in a direction. So, and that will flow on for months and months after the election, and very, very much so. So whatever the direction of the market is before the election, it's not going to change just because of the election. And that's really what I'm trying to say here. So just be careful using those sorts of, I suppose, wives' tales are probably some of them. People saying, oh, well, Labor's not good for the stock market, so therefore it'll come back. Not necessarily. It's not. If you go and look at history of who's in government and when the elections happened and what the market was doing, do a study of it. Don't just blindly believe what some people might say about things like that. But right now, I can see the market looks bullish. It's going to continue to be bullish, and it's looking really, really, really nice. So, and now you need to just look down into some stocks, into the sectors that are actually going to do quite well. And we did also look at that on our live over the last couple of weeks, our live sessions. So if you haven't watched them, get into them. Now I want to get into the stocks for this week that you've asked us to have a look at, and some of your comments there. I'm recording this on Sunday rather than on Monday because I'm in Sydney on the Monday. Instead of recording this, I'm in Sydney on Channel 10 doing some stuff on Channel 10. So I'm doing this a little bit earlier. That's why I'm not on the camera. But looking at this, if I go, where are we? I think that's where I wanted to be right here. So let's have a look at the first, I suppose, question that we've got here. I've got one from Mark Williams. He says Steve Johnson from Forager has got it right that active fund managers are charging high fees for passive results. Most fund managers can't beat the indexed either. And he makes that comment after my recording last week when I'm talking about ETFs and fund managers and everything else. Now, I've never heard of Steve Johnson from Forager. I'd never even heard of Forager, but I just did a little bit of research and found out their initial, how do I say it? They initially came out of the Intelligent Investor, and I actually knew one of the founders of the Intelligent Investor before he set it up and during and afterwards, and he was a very big fundamental analyst in terms of that, and big on fundamentals. I was a big technical analyst, and he eventually sold out of that, and he became a technical analyst because he every time he'd rung me about stocks and what my thoughts were on specific stocks, I was always of a different opinion to what he and his team were, and he eventually said to me, you get it right a lot more than I do, or our team does. So I thought that was quite interesting. But anyway, I've never heard of Steve Johnson and Forager, and he's got it right that active fund managers are charging high fees for passive results. I was saying that back in 2000 and in the 2000s. It's in my first book. I was talking about that and why and how it works, and saying that active fund managers do charge more, but they really don't do much better than with the fees better than passive fund managers, and also saying that most fund managers can't beat the index either. It's something that's not new, guys. It really is something that's decades. So it wasn't even new when I put it in my book. I just did some research and put some figures around all that for everybody and quoted some stuff. So if you haven't seen my first book or even my second book, Accelerate Your Wealth, my first book was How to Beat the Managed Funds by 20%. The second one, Accelerate Your Wealth, which just came out in the last 12 months. So get one of them and you'll actually see what we're talking about here. Now he talks about, Mark goes on to say, Buffett's 2013 shareholder letter stated that he would instruct the trustee of his wife's bequest to invest 90% in the S&P 500 index and 10% in short treasuries. And then he goes on, Labor will be a debacle for the share market. No, not necessarily. As I said, I don't think Labor will be a debacle for the share market. The share market will do what it's going to do anyway. If we're happy, we drive the market, not the government so much. The government really just steers the ship a little bit. And Labor, yes, they've been around, during some recessions, that sort of stuff. But at the end of the day, yes, the Liberals will be better for the stock market. Totally understand that. And I do hope the Liberals win. I mean, if people have looked at some of my podcast things like that, I grew up in a Labor voting household. I did. And, and I voted Labor for many, many, many years, and I voted Labor and I voted Liberal. But right now, I don't think the time is now the time to change the captain of the ship. We had 6 prime ministers in under 10 years. So now's not the time to have another one. And especially one that's really, some of the stuff that, they're looking at the Labor Party, it's not going to be fantastic for our economy. So I do agree sometimes a little bit with you, Mark, but right now I don't think it's time to change the ship. A bit about Buffett there, you need to be careful about putting things into context. Now, obviously this is assuming Buffett's passed away and he's instructing the trustee to, this is how they should invest it. And that's perfectly fine in that sort of context. But if you're 21 or 22, it's a different context. Or if you're 35, different context. So keep things in context. If somebody is retired and they're just wanting some little bit of growth and income, then what he's talking about there is perfectly fine. So keep it in context. The next question I got was from Andrew Canobra, and he says, I've got some shares in Biotron and Split IT. Do you think these are good shares and look promising for the future? Z1P isn't very expensive at the moment and it's been rising strongly. Is this a good share to buy? Also, what are your opinions on Atmos? Now, just reading that says to me that Andrew probably go to chat forums and get all your information or something like that, because it's seriously, Split IT we've talked about a few times, Z1P we've talked about a few times, because people keep asking about them. And generally when people are asking about stocks that are similar all the time, I don't know how many times people have asked me in the last few months about Split IT and Z1P. It just means they're all getting their information from roughly the same places, and my guess is chat forums, and that's the worst place to get your information from and your education from specifically, and more importantly your stock picks. It really is a bad place to go to that sort of stuff. Atmos, I haven't got that up on here yet, but looking at Biotron, look at that. This is a crap stock. There's only one way to talk about it, very illiquid, crappy stock. Look at the volumes on this thing. It's terrible. You're talking 2.6 million shares at 0.07 of a cent. There's not a lot of money goes into this, unless you're an experienced trader. Experienced traders wouldn't even trade this thing. You can see how illiquid it is, and you're looking at down onto a daily chart here. You've got 184,000 shares. Multiply that by 0.7 of 7 cents or 8 cents, and it's not a lot of money. And this is not a stock anybody. The interesting thing I find with there's an inverse correlation between knowledge and what you invest in. Those who with very, very little knowledge and experience invest in the most highest risk stocks, and they shouldn't, and those with the highest levels of knowledge and experience invest in lower risk stocks. And it just says to me, what do the people in the know with education do? That's really what you should be doing. The reason why people like myself invest in much better stocks is because they're much more solid, they're much more predictable, and they're much better to make money out of. And yet the majority of those who are uneducated tend to go for stocks like this, and the newest people on the market go for the smallest cap stocks. thinking they're going to make more money, but you're better off on the big end of town, guys. You really, really are. And it's something you're going to continually hear me say. The more you watch these videos, you'll hear it over and over and over again. And sometimes eventually you will start to listen, but it's not always the case with people. Here's Split IT, just really quickly. Again, another company at this point in time. It's a little bit better, but again, just thinking everybody looked at Afterpay. It was Afterpay, 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 and it took off like a rocket. Split IT is not another Afterpay, even though it's in the same area. There's now more competition. There's now 4 of these sorts of companies in you, and this is telling me that this is not super strong. So it's pretty simple. Just be careful of what you're doing here. Z1P, again, look at this more speculative type stock. Now it's running really hard, so it's not uncommon that somebody would be trying to get into this, and generally people in the know are well and truly in very early, and those that not in the know are getting in at the last minute. This is saying to me, very careful of this, because what goes up really fast will come down really fast, and we can see massive volumes going into this. So right now I wouldn't be buying into this stock. I'd be looking at exiting it. It's completely the opposite. From that point of view, I won't go into Atomos at this point in time. I think that's enough from these sorts of stocks at this point in time. But it really is, be careful. By the sounds of it, you're not that knowledgeable. I'm not trying to be rude to you, Andrew. I'm just saying it right now. If you're picking these sorts of stocks, Z1P's done really well. And if I don't know whether you're in it or you're not in it. But if you're not in it, I wouldn't be looking at getting into it from that point of view. But you can see here how it is just going rampant at this point in time from people getting at the end. It's a well-known fact, the amateurs buy at the top and the professionals buy at the bottom, and then the amateurs sell at the bottom and the investors exactly the opposite. Again, it's an inverse correlation between knowledge and skill and where you buy and sell from that point of view. So let's move on. I've got one from Bob. Bob says, do you think shares like Afterpay and CSL are overpriced? Again, Afterpay, but let's look at CSL. CSL is one of the best stocks on the market, bar none. It is absolutely a sensational stock. If you'd had CSL for decades, you would have been super happy with this stock in terms of how it would affect your portfolio. It just trends beautifully, and this is one of those great stocks. Right now, I like CSL. It's moving up. It's a little bit more indecisive the last couple of weeks, but it's nice. I think it's overpaid or overpriced. It's, to me, overpriced and overvalued or undervalued are fundamental terms. I just disregard those. To me, it's how do you work that out? And to me, is it in an uptrend or is it a downtrend? If it's in an uptrend, you get in and you're staying with it while it's trending up. Is it in a downtrend? If it is, then you get out and wait for the downtrend to finish. Right now, this is in an uptrend. That means if you own it, you stay with it. If you don't own it, you need to look at rules around whether you would get into it. Right now, it's not a buy, but it wouldn't surprise me if it wasn't a buy very soon. But it is looking really nice. So I've got some stuff from Roy. Roy says, thanks very much for sharing this. I'm assuming he means, so it was about my video. So thanks very much, Roy. I'm glad you like our content. Joe says, good content. Thank you for putting out the videos. Again, thanks, Joe, for that sort of stuff. Another comment I've got from Ian, he says, hi, thank you, Dale, for the info regarding ETF, something like hack, which I did talk about on the live show as well. So it's interesting that all the perceptions about ETFs are different to the reality around risks and benefits. You are correct. William Jago has actually given me a couple of questions here for New Farm and NIU, so I want to quickly cover those. He's put two separate comments on two separate videos, but pretty much they're the same thing, and you don't need to do that, guys. Just one comment on one video and I'll pick it up anyway. He says, currently I own NIU. What do you recommend to do with stocks like this that are suspended? I've also recently bought NUF or New Farm for a short-term gain as its volume was increasing and it had taken a large hit. What do you predict for the short-term future of this stock and do you think the resistance at 550 will make an impact? The second quote he had, thanks for your feedback, Dale. I'd like to know what you think of New Farm and NIU. The different bit on this comment is NIU was my first ever purchase and this shows. Okay, the stock is currently suspended. I don't know what to do. I want to sell and forget about this stock. When a stock is suspended, you can't do a damn thing. You're stuck. That's it. Simple. Until it starts to be quoted back on the exchange, you can't do a thing unless you do an off-market transfer, which means you need to find somebody off-market, like a friend or somebody else, that will take it off your hands, and then you go to the registrar and you get some paperwork from them, sign it, the other person signs it, and you transfer over the shares. You actually don't have to buy and sell through a broker, although that's the easiest and best way. You can actually sell shares off market if you'd like to do, but right now for NIU you are stuck simply until it opens up on the exchange. You can't do a thing with it. So he said, I bought with NUF, I bought shares on the 26th of March for a short-term gain, although recently the volume has started to increase and the share approaches a resistance. What do you predict for the short term? Volume increasing is absolutely no reason to buy a share. It's only one metric, and volume is, if I had to throw out any metric or any analysis method, it really would be volume, because volume, and I'll say this very, very slowly and very carefully, volume is next to useless to most traders. Unless you are trading day trading and you're trading highly leveraged and you big money, volume is next to useless to you to indicate the strength or weakness of a stock. Right now, as you can see, their new farm is in a downtrend very, very much so. Let's go quickly to he did say the 26th of March, so this would have been in this week. So let me go to a daily chart, which you would normally see me do. So here's the 26th of March is there. There is absolutely no buy signals here for me at all, so I'm not sure exactly why you bought the stock. There's an increase in volume in here. Quite often you'll see at the end of a run you'll get a bit of a spike volume, but that's not even conclusive. So right now, would I be a new farm? Not a hope in hell. None of my rules for owning this stock have been entered. In fact, it's probably what I'd be looking at is doing the opposite, not buying in. You're trying to bottom pick, I think, here, William, and I'm not trying to be rude, you're just trying to bottom pick, I think. NIU is the other one that you picked, and look at that. This is a weekly chart on the right and this is your monthly chart on the left, but you have a look at that. That's just a terrible stock. And again, Williams already recognized this as, he bought this without his knowledge, or bought it in his early days. And again, that's the real big thing that people do, is they buy stocks that they don't have knowledge on or experience to actually manage from that point of view. So good luck with it, mate. I really don't know what you're going to do when it opens up, or the story around it, but look at that. It's just a nothing stock. So I think you just wipe this down to experience, and when it does open up, try and get rid of it. But you never know. With the trading hold, it could be positive news. Keep looking at the news. But if it is good news and it starts to move up, just get out of it and wipe it, as you said. Rip the band-aid off really, really fast. That's what you really, really do need to do. But you can show, and on the live show and through these recordings, you'll see the majority of people that are that inverse relationship between knowledge and experience and what they actually buy, and it is the inverse. It's constantly the inverse. The best traders and the best investors buy the best stocks, not the opposite, and the ones that are the most inexperienced and uneducated buy the worst stocks in general. And it's an overgeneralization, but that's exactly how it works. So if you want to be successful, just using my book was over 200 and something percent for 10 years in my latest book that I show you how to make using only the top 20 stocks. So averaging over 20% per annum on those stocks over 10 years, including the whole GFC. So you really don't need to be a rocket scientist or a genius to get good returns if you're buying good stocks and you've got good rules around it. But that's it for me. I'll wish you good luck and good trading, and I'll talk to you next week. Take care.